Hello and welcome to TaxTixs, the tax podcast brought to you by RPGCC. I'm Kelly Power and today I'm joined by my fellow tax colleagues. We have Tim.
Hi there, I'm Tim.
Adam.
Hi, I'm Adam.
Anand.
Hi, I'm Anand.
And Taig.
Hello, Taig.
So Happy New Year to you all, if it's not too late to say that. This is our first tax podcast of 2026. And today we're going to chat through some of the key headlines and highlights from 2025. There have been a few recent developments and there's an interesting and packed agenda today. So that's going to range from looking at VAT recovery on deal fees. That'll link into Anand talking to us about EOTs and EMIs and possible exit planning. And then Adam's going to talk to us about APR and BPR. I think we'll have a few questions and things thrown into the mix during this. So, starting off with VAT. At the end of last year, there was a landmark decision from the VAT case Hotel Latour that was decided by the Supreme Court. So what does that mean for you? Well, this case has worked its way through the courts from the first tribunal many years back, finally with the case being decided and the decision published in December of 25. The case was an important one because it dealt with the recovery of VAT in relation to the sale of shares. So for many years, VAT incurred in relation to the sale of shares has been treated as directly relating to an exempt sale. And case law, both in the UK and the ECJ, has said that therefore, because it related to an exempt supply, VAT recovery was restricted. Hotel Latour, in their story, if you like, they owned a hotel in Birmingham, which was held within a company. They wanted to sell this company in order to raise capital to develop a new hotel in Milton Keynes, which I believe is your neck of the woods, Tim.
Yeah, that's where I live, yeah.
Yeah. See that from your house or?
Almost, yeah, as you walk out the front door, you can see it. So you can see it pretty much everywhere in Milton Keynes. It's the highest building in Milton Keynes. So
it's quite a property, isn't it? Yeah. We had the VAT annual conference there the last time I went. So whether they chose that because there was a VAT specific case about it, who knows? Anyway, a really kind of quite incredible development. And in order to fund that, they wanted to sell the company holding a hotel in Birmingham. So they sold the shares in this company that owned the hotel in Birmingham. And their argument was that VAT incurred in relation to the sale of the company was directly linked to the development of the hotel in Milton Keynes and therefore future taxable generation of income from that Milton Keynes hotel development. HMRC disagreed with this quite strongly and said that the input VAT had been incurred in relation to the sale of shares and therefore should have been restricted. Hotel Latour decided to argue this case, as I said earlier, that started in the first tier tribunal. First tier and upper tier tribunal ruled in favour of Hotel Latour. HMRC continued to challenge the decisions. And at Court of Appeal level, the Court of Appeal agreed with HMRC and said, no, what you need to look at is what was the direct and immediate link of the costs that were incurred by Hotel Latour. And you couldn't look through the sale of shares. You had to look at the purpose of the costs that were being incurred. And the purpose of those costs directly were relating to the sale of the company. This is what the Court of Appeal held in ruling in favour of HMRC, and the Supreme Court just at the end of last year also agreed. So it brings to an end a period of speculation which had been settled case law for quite a long time, both in the UK and at ECJ level, and then risked being unsettled, potentially hugely in favour of the taxpayer by the FTT and upper tier tax tribunal, but then common sense and proper application of the law prevailed with the Supreme Court deciding that the VAT should be properly restricted because it related to the sale of shares. So an interesting case, something that VAT practitioners have been following. And I guess for this, just to be mindful that where you are incurring VAT, whether you're selling a company or if it's relating to a deal, really just to think about how you're treating that VAT on associated costs when you're looking to sell or exit a business in some way. And I think...
Can I just ask you a question
Yeah.
about that, Chris? So you mentioned at the start of the ECJ, are
Yeah.
the European Court of Justice cases still relevant following Brexit? Do you still follow those decisions?
It's a great question because UK VAT legislation is derived from European law, unlike our other taxes in the UK. Obviously, following Brexit, the UK can make their own VAT legislation now, but case law that was decided prior to Brexit still is good law and can be relied on by taxpayers. So, yes, in answer to your question, it is still relevant. So I think that that's quite an interesting view on sale of shares and just thinking about raising capital and potentially exiting a business. And I think, and we were speaking earlier, and there have been some changes to EOTs and EMIs. So did you want to just talk through that and what those changes are and what they can mean for businesses?
Yeah, thank you, Kelly. So the changes on EMI, if I take that one first. So at the budget last year, back end of last year, as it was, the Chancellor decided to expand the availability of the EMI scheme. So an EMI scheme is an employee share option scheme, and it's a tax incentivized way to basically share a stake of the company with employees. It's a discretionary share scheme. So if a company decides to implement an EMI, they can choose who in the staff they want to give the options to, and they can be varying levels. There's no requirement for it to be fixed to everyone or to have similar proportions. They can be designed however they wish. And so they're tax incentivized because what it does is it gives the opportunity for an employee to get a stake in the business, effectively a promise for a stake in the business, i.e. the share option, almost at day one. And then they hold that share option. And often most EMI schemes, they'll have effectively a monetization event when there's a sale of business. At that point, they can then exercise the share option, become a shareholder and sell the shares all on the same day. So it's quite neat from an employee point of view in that you don't have to pay for anything up front. You're awarded these options and then you can monetize them as a sale event. From the employer's point of view, actually the founder's point of view, really, because it's their stake, their share of the business that they're giving up. They also, again, are not massively committing to give straight shares. They're giving options. So again, there's other criteria. So they're effectively conditional awards, aren't they? Because if you've got an exit, that's only when they can actually turn into something of value. So it kind of works from that way. It's quite neat to say that here's this promise and it can turn into something. It's quite a good retention tool. So
I was going to say it's a good sort of benefit for an employee to have.
It is. And there's that classic about aligning objectives as well.
Do you find that it actually does work, that the incentives there are for employees and employees value getting an EMI?
Absolutely. I mean, it's I think a very valuable part of an employee package. People look at salary, and that's classic. Your day to day, you need the salary, but it is looked upon sometimes as a bonus, and the traditional sense of here's a cash payment. But if you can get people all working together to go, let's grow the value of this business, because actually at the end of it, you will benefit from it as well as the founders, then it works really well. And I think what we're finding is, and certainly in certain industries, it's almost expected. So the classic is your tech startups.
Okay.
It's expected. It's normal, and often you'll have US headquartered tech companies that are set up in the UK, and again they'll have already a stock option scheme there, which you can adapt to make it fit within the EMI. So it is quite common. And I think what we're finding, we were having a chat earlier, weren't we, about generational expectations. I think certain
in the workplace.
newer people coming into the jobs market, they're probably expecting as well, let's have a stake in this business, because they want to feel that they're all driving towards the same goal, and it's just not just the salary.
Yes.
The attractions there. So when I refer to them expanding the the availability, it basically means that bigger types of companies can now, actually, based from 6th of April, be able to qualify for EMI. So it should mean there's more scope for companies. There is a restriction on types of businesses that can do it. So like property businesses don't qualify, and that's not changing. But in general, most trading businesses should be able to, in very broad terms.
And is that limited by sort of employee numbers, headcount,
Yeah,
value of the business, turnover?
exactly. So EMI is designed for your classic owner managed business. So one of the changes coming in was on the headcount. It's going to be up to 500 employees.
Oh, wow.
So it's, as I said, they're making it much wider. And I think that is also says something about the political angle to this. There is, as much as people, business rates going up and national insurance, I think this is a real championing of employee share ownership, and a real a desire for the government to say, actually, we're putting things in place to make these things attractive so that business owners can give up parts of their business, and it benefits all the way around. So actually the company gets corporation tax relief as well when there is an exercise, creating a tax deduction as well. So there's a benefit almost all the way around. In terms of EOTs, employee ownership trusts, that's one of the areas where actually they've curtailed the reliefs. So it was announced again at the budget that the relief will effectively be reduced. So prior to the budget, you could sell to an employee, a founder could sell to an employee ownership trust and pay zero capital gains tax. And post-budget, and it actually happens from budget day, if you sell to an EOT, only half of the gain is exempt from capital gains tax. The other half is chargeable normal capital gains tax rates, so it's 24%.
That's a significant change that hit immediately then.
Exactly, significant change. And you're right, it wasn't, there were certain things that people were expecting in the budget. That one, I think, came out of the blue a bit. However, it does come off the back of last year's budget where there are EOT changes and other consultations that have been ongoing, because I think the EOT legislation has been around for over 10 years, and the first 8 years nothing changed, and then it actually has. I think the government have said they've tried to change the focus of it, make sure it's the right type of exit. So employee ownership trusts, the reason why I think founders like to consider them, aside from the tax benefit, is it allows you to effectively call it an internal sale or a friendly sale, because you're not looking in the market for a third party buyer. You're selling to what is a separate entity, the trust, the employee ownership trust. But what's quite neat about it is, even if there isn't enough money in the business to essentially pay you out, pay you for your shares, it does work such that the future profits of that company can be used to pay your proceeds. So in most EOTs that we see, you don't get paid out upfront. It's actually you get paid out by deferred consideration.
Yeah.
Just because there's the cash in the business, obviously the business still needs to run. So again, when I talk about focus of the EOT, it is designed for long-term ownership. It's really to protect that company, to keep it going.
Business continuation.
Exactly.
Yeah, and it's really interesting changes, and I think they link really, really well into the APR and BPR changes, talking about business continuation and the purpose behind those, and the changes that we've seen there, and how they've gone down in the media. Do you want to talk about that a bit more, Adam?
Lead balloons, I think, is the easy description. Yeah, I mean, BPR, business property relief, that was originally in place. So your family business, when Grandad, who set the business up in 1900, dies, that business would pass on to his son, probably at that point, but children, and the business would just carry on for generation after generation. And that's where some of the world's largest companies have come from. I think of something like Ford, family business originally, not anymore, obviously, but there's still some massive family-owned businesses. And without business property relief, realistically, that can't happen, because when the old man who sets the business up dies, 40% of the value of that company is subject to inheritance tax without it. And the only way people can pay the tax is to sell the business, and then your family legacy has gone. So business property relief is still currently unlimited. From 6th of April, that will change. Luckily, Keir and his cronies have done another one of their U-turns. So they were going to reduce the limit to £1 million. It's now going to be £2.5 million. So there's a bit more value of your family business that you can pass on tax-free. And that 2.5 is obviously theoretically double to where you've got the husband and wife ownership or husband and wife existence. So that's BPR in a nutshell.
And I suppose if you don't have a husband and wife situation, or that formerly owned that business as husband and wife, can you make arrangements now so that the spousal couple do own 50%, so you do benefit from each of them? Something that could be done there?
It can be. I mean, there's a lot of benefit to having joint ownership anyway. And I think where we've got a family company, we would probably always have some ownership with each spouse just for general tax efficiencies, day to day, year to year. It's not the end of the world necessarily on death, as long as husband leaves to wife or wife leaves to husband 100% of the estate. There will never be an inheritance tax charge on that death. It's just when the second one dies that we've got an inheritance tax issue. So yes, you can do something, but you don't necessarily have to. There are some things you can do with a very limited window now, looking at trusts. Not going to go into that now, but whilst BPR is still there at 100%, you could chuck all of your shares into a trust before 6th of April, before the change, and there won't be an inheritance tax liability in doing that. Obviously, there's downsides. You've given away your company. So it needs a lot of thought, but the opportunity is there for people who want it. APR, agricultural property relief, very similar. Anyone who lives in London probably saw tractors around Buckingham Palace shortly after the budget. And anyone in a rural community will have seen placards on every farm about inheritance tax. So again, very similar picture. Currently, Farmer Giles dies, unlimited amount of his farm is free from inheritance tax. Come April next year, not the same situation. And we've got that £2.5 million limitation again, which again, for farms, I think one of the big bones of contention here is farms are very valuable, but they often generate very little income. So the only way someone is going to be able to pay an inheritance tax liability is to sell off 40% of the family farm. And if you're doing that every 30 years, every generation, then it's not long before there's nothing left. And I don't know what happens to the farmland. It goes to something, and it won't be food production. Let's put it that way.
So developed, or
so keep the countryside safe, keep APR in place.
Will these changes, do you think, encourage businesses to transfer assets earlier? You know, planning, I guess, won't keep it until the very end, I suppose, knowing that these changes are coming in.
Yeah, you would hope so to a point. I think, everyone, if we had crystal balls, everyone would give everything away 7 years and a day before they die. At the moment, AI isn't that clever. Maybe in a few years' time, it can carbon date us forwards, but I think that's a bit much to ask for. But if any scientists can do that, let me know and we'll go into business together. So I think it will prompt more conversations with business owners, with farmers who no longer have that safety net of knowing there's no inheritance tax. The call to action will be earlier, like it would have been historically for anybody who wasn't a farm owner or a business owner.
Yeah, I think from what I've heard, and anecdotally, I mean, that is essentially what people will have to do now is move assets down faster. But I think it was the ones who got caught out who, potentially with businesses, you probably got younger owners, but in farms, they're in them forever until you pass away effectively. So it's the 80-year-old farmers who now suddenly go, wow, I've either got to give it away or suffer or try and, live for 7 years, or you've got the £2.5 million to play with. So those are the ones I think have been a bit caught out by this because they're just at an age where the likelihood of their 7-year survival is low. But I thought it was interesting because I actually read, being the sad person I am, I've actually read the Commons report about the agriculture property relief, business property relief. It's essentially a summary of where the policy came from and the debates they had about it in Parliament. And it was interesting, particularly in relation to the APR, is that this whole idea of reducing the APR came from a tax think tank called Tax. And what Tax actually suggested was two things, one on the APR front, one on the BPR front. On the APR side, they said you can, under current rules, get the 100% relief on farmland that's rented to someone else to farm. And they said, isn't that just an investment property? Why should you get APR on that? And to some extent, you might go, fine, well, that's not a family farm then, is it? then I can see why you might not get relief on that. Nowhere did they say, let's abolish APR altogether and reduce it to 1 million or 2.5 million. That just never entered their thinking. And similarly, on the BPR front, they questioned why shares in AIM-listed companies get 50% relief when they're just investments. Where's the business activity? What are you actually preserving there? So whilst that removal could have a massive impact on the AIM-listed markets, you can again see the logic that it's not strictly a business activity in the same way as a family-owned company is, so you might want to remove that relief. But again, there was absolutely no mention in their think tank's report, which was drafted by a professor of economics, to suggest that they should limit BPR at all. So that came out of the blue like last year. I've also read the Commons report on EOTs as it goes as well. And that was a lot more logical. They'd actually got empirical evidence, and they said the reason they changed that was because 90% of relief went to 10% of sales effectively, which meant effectively people who were very wealthy were just selling their companies to EOTs and extracting cash, which really otherwise have been taxed as dividends. And therefore, why should you get this tax-free exemption for transfers into EOTs? So again, you can see some logic there that they want to encourage employee ownership, but therefore have the reduced tax rate, but at the same time not making it tax-free because people are doing it just for tax reasons, which should never be the right reason, really. So you can see why that happened as well. So when you read these things, it actually helps embed the logic behind the policies. It's a lot better than sort of just hearing the headlines sometimes to actually understand what we're really trying to achieve here. But as I say, I think the APR and BPR ones went too far. The logic is lacking now.
Yeah, it sounds as though the rationale was there in the original report, but perhaps they picked up the wrong thread and ran with that.
Yeah, they took it too far.
Yeah.
And out of interest, did either of those Commons reports, well, I suppose mainly the APR, BPR one, did it talk about the valuation issue?
Not particularly, but I know once they introduced the 1 million limit, Tax have gone back and have been campaigning for a 5 billion limit, which then ended up at the compromise at 2.5, where they changed it from the million. But no, they haven't really thought about the valuations and just how many people this will impact. Because certainly on these where these reliefs have applied in the past for inheritance tax, I think the evidence is going to be lacking, because if you thought your property, your shares in a trading company or your farm qualify for 100% relief, just how much attention are you going to pay to valuing that property when you put it on inheritance tax form? You're not really going to care if it says 4 million or 5 million from an inheritance tax perspective, because it's exempt. So there are CTT implications, but from an inheritance tax perspective, you're not going to be that bothered. So I'm not convinced they're using correct data, because I'm not convinced people have really thought about the values they're putting on those inheritance tax forms to the correct degree that they will be now. I think there's far more farms worth more than 5 million quid in this country than they believe there are.
Yeah.
Because you just average, farmland property is probably worth 10,000 an acre. You only need a 500 acre farm to go above those limits before you've added in combine harvesters, the farmhouse, and everything else. So I think there's an awful lot of farms caught by this who shouldn't be.
And practical issues at HMRC's then trying to police.
Yeah, they're
Fire
going to
a
have to go out and value every single farmland in the country eventually. So.
And we know that HMRC are already massively under-resourced, so I'm sure that they won't be grateful for that extra job. Yeah. Okay. Well, I mean, some really interesting developments there. Unfortunately, not in the taxpayers' favour for the most part, but hopefully we've brought to you what those changes, the background to those changes, what they mean for you, and how you can tackle sort of navigating those. So thank you for joining us on TaxTixs, and we look forward to speaking with you again in February.